You're welcome back, my dear professional students. Now we'll continue from where we stopped in the previous video. And in there, we were looking at requirement C that bent on preparing the statement of profit or loss and other comprehensive income, and also the statement of changes in equity for the year ended. So, to do that, we need to carefully look at our notes. From the requirements A and B, we have done a lot with this additional information, but let's make sure we touch everything. In here, we have been able to determine the value of opening inventory, which we determine as part of requirement A, in fact as requirement A, and also requirement B gives us the value of the closing inventory, and this requirement C is pointing us to the fact that there is a prepaid salaries and wages. Okay, there is a prepaid salaries and wages. So let me go to my workings and show you how we adjust for that. So workings, we have a prepaid salaries and wages. It was 10 million. He gave it to us as 10 million. Let me confirm it. Yes, it's 10 million. And when there is a prepayment, what this means is that some of the salaries and wages we have paid the next period in this current period. That's what it means. We have paid for next period in this current period. And based on the principle of accrual, this prepayment, which we have paid in advance, okay, we have to remove it from this current year account. So we'll credit that expense. You remove it from that salaries and wages, so that the salaries and wages, the expense we will have is the one that relates to this current reporting period. Because this 10 million relates to salaries and wages of the next period. Okay? And in preparing the statement of profit or loss, we want to show the expenses and income for this current period. And prepayment means expenses that has been paid for the next period. So we need to remove it from the salaries and wages in the statement of profit or loss. And in the statement of financial position, we will debit prepayment. So we are going to have a prepayment in the statement of financial position. So now, in crediting this, we'll go to our trial balance and see our salaries and wages. And here the salaries and wages we have is 80 million. So as per our trial balance, we need to adjust it straight down. So as per the trial balance, TB, the salaries and wages was 80 million. So we deduct the prepayment, the prepaid salaries and wages, which is 10 million. So that means what we'll recognize for that salaries and wages will be 70 million instead of 80 million. Okay? That's that. And we're told that included in the plant and machinery cost was depreciation of 14,800. So what that is pointing at is that we have to remember to reclassify depreciation of 14,800 from the machinery maintenance costs to the depreciation account. So let's quickly do that. Now be workings 2. Workings 2. or classification of depreciation costs. So it was in maintenance costs. And the maintenance cost we have in the question was the plant and machinery maintenance cost. Yes, this is it. And it's 44,800. 44,800. So I will remove the depreciation cost from it. And the depreciation cost I'm removing from it is how much? Is 14,800. 14,800. So what I'll be left with to be 30,000. That is what I will recognize for maintenance cost, 30,000. So let's go back to our note. Now I'll go on to note 5, right? Note 5 states that the allowances for receivables are no longer required. Okay? So what they are saying there is this. These allowances for receivables, here they call it provision for receivables. This 21,200 should be derecognized. We should not recognize it at all in the books. They said it is no longer required. Okay? Furthermore, we're told that the 10% loan note interest was paid on 30th June 2014, and this has not been accounted for. So it was paid at the end of the year. This is the 10% loan note. This is the 10% loan note. And in here, we have it as 100,000. So for it to be on the debit, that will show that it is a financial asset. So we'll be receiving the loan. We'll be receiving interest. And if you look at it, they have not recognized any interest before now. Okay? They have not recognized any interest before now. So this loan interest, okay? This loan interest received, which should be 10% of 10,000, that has not been accounted for. We will need to account for it. Loan interest received, I'll make that working straight. Loan interest it's going to be 10% times 100,000, and that's 10,000. And this 10,000 will debit cash because we are receiving, and will credit income or interest received. Okay? Alright. We're now told that the fair value of goods is 40 million. This 40 million is the fair value of the inventory. The carrying amount of the inventory is 9 million. This is the fair value. Definitely, we are going to recognize this 9 million and not this fair value. The delivery van for the year to 31st, okay, we have already worked everything about delivery van because they already asked questions on it. And that's what note 6 and 7 is talking about. And this is the current tax provision, which is 165,000. So let me make that note 4. Current tax provision. Now, if you have any tax within the trial balance, if it is on the debit side, it means it is an under provision for tax. If it is on the credit side, it is an over provision for tax. And from here, we don't have any. We don't have current tax. Okay, let me quickly confirm this credit side of the trial balance to be sure that it's balanced. Because if it's not balanced, it will affect. That means they will have made a mistake somewhere. So 41,150 plus 37,000 plus 12,000 plus 940,000, right? Plus 30,000 plus 30,000 plus 100,000 plus 8,000. See, it's not balanced. What I got is 1,219,370. That means this 10% loan note that was placed on the debit side should be on the credit side. Yeah, I was wondering. Because they told us they paid. That we paid, not we received. Okay, so thank God I confirmed it. So this should not be loan interest received, it should be loan interest paid, like a finance cost. So you need to be very careful. So instead of debiting cash, because now we are the one paying, we have to credit cash and debit finance costs. So debit finance cost or interest paid. We are the one paying, so we credit cash. Okay. Now this current tax provision. So the estimate for the year is 165,000. There was no under or over provision. So job made easy. So we'll simply debit POL as the income tax expense and we credit current tax liability in the statement of financial position. Current tax liability. Okay. And that's that. So we have extracted the workings that relates to the additional information. But you need to figure out if there are any assets in the account apart from the delivery van. And of course, there are assets. And for me, I can quickly see plant and machinery. Okay, so we need to determine the depreciation for the year for that, as well as the carrying amount. So let me go and make that my next working. The cost was 75,500. That'll be my workings 5. So plant and machinery. The cost was 75,500. Then the accumulated depreciation, they gave us already, was the accumulated depreciation. That's the provision for depreciation, and it was 41,500. It is 41,500. Okay, so let me go and have it there as 41,500. For the 1,150. 41,150. 41,150. 41,150. So And we also need to determine the charge for the year, meaning the depreciation charged for the year. So did they tell us how we will determine the depreciation charge for the year for the plant and machinery? Okay, yes. They already told us that all non-current assets were depreciated at 10% per annum on reducing balance basis. So with that information, we are more than sufficient. So that will be 10% multiplied by the carrying amount at the beginning of the year, which is 75,500 minus 41,150. That's 34,340. So multiply by 10%, that's 3,435. So the carrying amount for the plant and machinery will be 75,500 minus 41,150 minus 3,435. So 25,500 minus 41,150 give me 34,350. Where did I say 340? What is wrong with me? 3435. Okay. So 75,500 minus 41,150 minus 3435. That gives me 30,950. Okay, so this one will be the depreciation for the year. Alright, so let's go and check for another asset. Apart from the plant and machinery, another asset I can see here is furniture. I can see the provision for depreciation, but I need the cost of the furniture. And the cost of the furniture was 64,000, right? So the cost of the furniture is 64,000. Cost of the furniture is 64,000. Deduct accumulated depreciation, which we will find in the question. What's the accumulated depreciation for furniture? And it is 37,000. 37,000. In jackets, then we deduct the charge for the year, which is the depreciation for the year, which is 10% reducing balance, which is 64 minus 37,000, which is 27,000. That's 2,700. So what will be the carrying amount? Carrying amount will be 64,000 minus 37,000 minus 2,700. And that's 24,300. Okay. So is there any other asset apart from that furniture? I can see freehold land, and land is not depreciated, so we'll ignore that for now. Okay, those are the only 4 assets we have in this question. Okay, so now we are ready to prepare the statement of profit or loss. We are going to do that in the next video. Thank you very much.